Hello and welcome to Money Talk. I'm Kim Parley, and we certainly hope that you had your seatbelt on this week and last week. Investors were subjected to wild swings in the market as stocks came under pressure and whipsawing trade. Is more extreme price volatility coming? Should you be prepared for that? And what should investors do to ride through those turbulent markets? Joining me now, Bruce Cooper, Chief Investment Officer at TD Asset Management, with almost, over $300 billion in assets under management, here to tell us what he's seeing right now. How are you?
Terrific, thank you.
Why is this happening? To start with that, I mean, I think that, because, people kind of talk about, China slowing down and this and this and this, but why is your sense, why now? Because none of this seems to be net new information.
Yeah, well, I think, first of all, you are right. This is about economic slowdown. I think that's the consistent message the market's giving us. Stocks are down, interest rates are down, and commodities down. I think all that's telling us the market is worried about slower growth. We've lived, one of our key themes for 6 years has been we live in a low-growth world, and that hasn't changed, and that's particularly been true of the developed world. The US, Europe, Canada, we're all growing pretty slowly. I think what's changed a little bit here is mounting fears that growth in the emerging world is really slowing pretty significantly. You referenced China, and certainly some of the data coming out of China would suggest that growth there is pretty slow. But of course, not just China. If you look at Latin America, growth is sluggish, Eastern Europe, other parts of Asia outside of China. I think it's all sending a pretty consistent message that global growth is in a bit of a soft spot here.
It feels as though, and I want to get too inside baseball in terms of this is a global beta market, that everything is moving up and down together. Yep. And then everything is selling off, and we have to kind of take our cues from the Chinese markets to see what they're doing, and then generally we're either getting the complete opposite reaction or we're completely moving in tune. Is everything off right now? Well,
not everything's off. Of course, bonds are up. Interest rates are down, but the price of bonds is up. And so one thing we've talked about is the importance of a balanced portfolio, and the role that fixed income can play in a portfolio is to provide stability. And certainly you're very grateful to have that stability in times like we've seen over the last couple of weeks. I'm going to just pause for a moment and not say, I don't want to get into what to do quite yet. I want to kind of just back up. So what are we seeing from here on in? I mean, we're seeing, 500-point swings now daily. One day it starts off with an 1,100-point dip. Are we just kind of swinging towards equilibrium, do you think, right now? Or are we I think it's important to step back a little bit. First of all, you need to remember that markets have gone up a lot. If we step back and take the view from, say, 2009 through recently, ever since the financial crisis, the markets have been on a big run.
On a one-year basis, though, it's not a pretty chart.
Nope. I think we've had a kind of cautious perspective, and that's really been based on a couple of things in stock markets. One is this idea we do live in a low-growth world, as we've just been talking about. Linked to that is the idea that earnings growth is actually decelerating. And then finally, valuation is kind of in the range of what we would think of as fair value. So, stocks are down a little bit in the last week, obviously, maybe 10% in the last month or so. But if you think about those three factors today's talk about, growth is still slow, earnings is still decelerating, valuation is more attractive today than it was a month ago, but it's still, in the range of fair value. I don't think you're seeing outrageous cheapness. Now, we do see cheapness appearing in certain stocks. Anytime you get everything selling off, there's certain things that pop up as being quite attractive. But in aggregate, I'd say the market's still somewhere in the range of fair value as opposed to being cheap.
If you take a look at specific points in the world, let's say, China, you and I have chatted about this before, so the discrepancy between what the official rates of growth are, between what data is showing you right now, do you think we're moving more towards an official realization that the growth is lower?
Yeah, I'm not sure. So the Chinese government will tell you that growth is 7. We think growth is much lower. I have no idea what the Chinese government will tell us, so I'm not sure if we'll close that gap.
And does that matter now?
I think in a way it doesn't matter. I think I step back and think China, I think growth is slowing, and I think they've got a combination of what I would call structural challenges and cyclical challenges. The structural challenges will be with us for a long time, and I would consider some of those to be changing demographics. The one-child policy in China is meaning the labor force is growing much more slowly. Debt is very high in China. They've got a lot of state-owned enterprises that are fundamentally inefficient. They lack, in some cases, the rule of law. These are structural challenges that would probably slow growth over a pretty long period of time. Then they've got some cyclical challenges, like the real estate market has excess inventory and the auto market has excess inventory. Those will be worked off, and at some point growth will re-accelerate a little bit in China, but probably not back to the levels we saw, for 30 years. So, somewhere between the 7 where we are officially and, a lower number where we are today, we'll probably land somewhere in the middle as we go through the next few years.
How is the U.S. looking throughout all of this? I mean, we had some pretty good, this is one data point. Durable goods numbers were very strong today. We're still waiting on a Fed decision, September, December. But how would you say the state?
Ever since the financial crisis, the U.S. has been growing at roughly 2%. And today it looks like it's going at 2%. So I'd say it's steady as she goes. It's not awesome.
Although it's funny that we say that's the bright light when 2% is the bright light.
It used to be the U.S. grew 3 to 4% in an average year. And now it's growing at 2. So it's I have my analogy of a car. It's a car in third gear. It cannot get into fourth gear, but it's running along in third gear. There are parts of the U.S. economy that look pretty good. I think the jobs market looks pretty good. The housing market looks pretty good. Obviously, the oil and gas sector is struggling mightily now, having been a big contributor to growth for many years. So it's a mixed picture. But on the whole, I think the U.S. is doing pretty well.
All right, stay with us when we come back. We're going to have more with Bruce Cooper. We're going to talk about how you take this pretty good economy and actually try and turn it into something that's better than good in your portfolio. So stay with us. More on that when we come back. And any comments or questions, we do love to hear from you. Send them to moneytalk@bnn.ca so we can answer them for you in the show or find the right person to answer them for you. More Money Talk when we come back. All right, welcome back. I'm here with Bruce Cooper, Chief Investment Officer at TD Asset Management. We've been talking about the global sell-off that started in China. All right, but let's bring things a little closer to home and specifically what it means for you and your portfolio. I'm paraphrasing you here, but it's kind of like, meh, that's kind of the economy right now. It's just kind of, But so when you have an economy that's like that, what do you do?
Well, I think as an investor, this is not about trying to shoot the lights out right now. I think you see the merits of diversification when you get into a market like this. I think you want to have some bonds. Interest rates are low, but you want to have some stability in the portfolio. I think if you're a Canadian, having some global equity portfolio, because that gives you some currency diversification, is a great idea. I think in the equity side, focusing on companies that pay good dividends, because we believe interest rates are going to remain low for a long period of time. So if you've got very high quality businesses that can pay good dividends and grow their dividends over time, that makes sense. And maybe having a small amount of cash so you've got some flexibility is not a bad idea either. Well,
it's funny you should mention that because I, before coming on tonight, I've been surveying my own informal survey, calling around and asking people what the reaction has been to the sell-off. And no one, what I've heard, and again, sample size, this is not statistically reliable, but it's, I was expecting to hear a little more of a, oh no, what should we do? And the concern, it's been more, is now the time to buy? So I don't know.
And as you know, stocks have fallen pretty hard. And so I think bottom up, when you have these big sell-offs, you can always find opportunities. As I said earlier, if I look from a macro perspective, I don't think the market's a screaming buy. But within that, there will be opportunities that present themselves. And, we look to take advantage of those opportunities for sure. But
it's sector by sector, stock by stock. But there's just a lot. What do you? I guess if 5 years from now, you and I are sitting and having this conversation. What do you think we're going to be saying about the last 5 years? I mean, were they volatile? Were they?
I think it's going to be an era of modest returns. You think about a balanced portfolio. The fixed income side, as I say, we have advocated that you have some, but bonds are going to give you low single-digit returns. We think investment-grade corporate bonds look attractive, but it's still low single-digit returns. We think equities could be kind of a mid-single-digit proposition.
And you guys actually, I think, made the call back in March. Did you not?
We actually, you're right. We became more cautious on equities in March. We actually sold equities and bought bonds, which some people thought was a surprising move because, of course, at that time interest rates were still fairly low. But actually, since then, bonds have actually outperformed stocks by a reasonable margin. So, that is that merit of having stability. And stocks, I don't think will give you the same return over that 5-year period that you refer to as they have, say, over the last 20 years, or for sure over the last 5. In the last 5, The starting point, of course, was the end of the financial crisis, so the stocks were very depressed. I don't think you're going to get those kind of returns in the next 5 years. And mostly because earnings growth is probably going to be lower, and PE multiples are already at around average levels.
Right, since the sell-off we've had right now.
That's right.
And in terms of geographic preference, in terms of what you're looking at right now, you have, I know before we're stronger towards the U.S., you've shifted.
Yeah, we don't have a strong geographic preference today. You know, the U.S. probably is the strongest economy. The stocks there probably a little more expensive. You know, Europe, a weaker economy, weaker earnings growth. The stocks are a little bit cheaper. When we kind of weigh it all together, we don't see huge geographic opportunities. The emerging world does look a little riskier to us. So, you know, developed world probably looks a bit better than the emerging world, but you know, it's not we don't see table-pounding geographic preferences at this point.
And last question for you, volatility. Do you expect, I mean, we're in a, you know, a moment in time right now where it feels really uncomfortable, but.
You know, our core message all year long, we started giving this message in January of this year, was we expect more muted returns with higher volatility. And we went through about 7 months this year where volatility was at rock bottom levels, and in the last 2 weeks, kaboom, they've gone very high. Volatility tends to be episodic. You know, you go through long periods where nothing much is happening, and then you get these events. The reason we thought volatility would be higher is we see these kind of danger spots around the world. China was one that we've been talking about for the last couple of years. Europe, likewise, we think has, we call them unresolved imbalances, you know, kind of a fancy way of saying
very polite way of saying it,
things are not going that well. And we can see that those imbalances will rear their ugly heads, you know, again over the next couple of years. A big one for us, and we've talked about this consistently over a long period of time, is debt is too high everywhere. And debt can create its own volatility. Debt can be a conductor of contagion. So, you know, a problem in one place can turn into a problem in another place, and it can turn a little problem into a big problem. So, you know, for that reason, we think you should focus on very high quality businesses. You want businesses with strong balance sheets, you know, strong competitive advantages. You can survive this volatility. You know, if you own a good business and it goes down 10%, as long as it's not permanently impaired, you're fine. But you want to have that quality bias to navigate this more volatile environment.
Bruce, it sounds as though we have to get ready and just be fit and grind it out for the next little while. Pleasure having you here.
Great to be here.
Bruce Cooper, Chief Investment Officer at TD Asset Management.
TD Well.